Every loan is sold with the same promise. This will help you grow. Borrow now, pay later. Prosper soon. Nations are told loans will build roads, stabilize currencies, modernize economies, and lift millions out of poverty. Yet decades later, the same countries are still borrowing, still restructuring, still recovering. Here's the mystery no one explains. If loans are meant to create independence, why do they so often produce permanent dependence instead? Why do nations that borrow the most seem to gain the least control over their future? Because behind endless loans is a long game, one that doesn't rely on invasion, occupation, or force. It relies on time, interest, and incentives. Stay with me, because this story isn't about evil masterminds or secret plots. It's about a system that rewards dependence and punishes escape. Setting the stage, debt as a tool of progress. Debt wasn't always dangerous. At its core, lending is simple. One side has excess capital, the other needs resources. Both expect mutual benefit for centuries. Loans funded trade infrastructure. Recovery after disasters, temporary shortfalls. Debt was meant to be temporary. You borrowed. You invested. You repaid. You moved on. That's how it was supposed to work. But modern economic systems quietly changed the rules. Not all at once, not loudly, but gradually. And once those rules changed, loans stopped being bridges. They became anchors. Origins, when debt stopped being meant to end. The roots of permanent economic dependence stretch back to the rise of modern banking and sovereign debt. In earlier eras, default was a catastrophe. Kings who failed to repay lost credibility, and sometimes their heads. Lenders were cautious. Borrowers were restrained. But the creation of central banks and global financial markets changed that balance. Governments discovered they could roll over debt instead of repaying it, borrow to pay previous loans, separate political cycles from financial consequences. Debt no longer needed to end. It only needed to be serviced. Interest payments became more important than principal repayment. This was the first quiet shift, and it changed everything. The first twist, interest as a control mechanism. Interest seems harmless. A price for time. A reward for risk. But on a national scale, interest does something subtle. It creates obligations that compound faster than real growth. Economies grow slowly. Debt grows relentlessly as interest accumulates. Budgets tighten, policy options shrink. Flexibility disappears. Loans stop funding development. They start funding survival. Survival is negotiable. The rise from national debt to global dependence. By the mid-20th century, lending became international. Institutions like the International Monetary Fund, the World Bank, regional development banks were created to stabilize economies and prevent collapse. Their mission sounded noble: prevent crises, promote growth, encourage stability, and in many cases, they helped at first. But the structure of their lending embedded a deeper dependency. Loans came with conditions: currency devaluation, spending cuts, privatization, policy alignment. These were framed as reforms, but reforms reshaped entire economies around repayment capacity, not long-term independence. Cause and effect: how loans shape behavior. Here's the cause and effect chain that defines permanent dependence. Step 1. A country faces crisis, recession, war, commodity shock, or mismanagement. Step 2. Loans arrive to stabilize the situation. Step 3. Conditions force austerity, limiting domestic investment. Step 4. Growth slows, but debt obligations remain. Step 5. New loans are required to service old ones. At no point is repayment realistic. The system isn't designed for exit. It's designed for continuity. The psychological shift from sovereignty to compliance. Over time, something deeper happens. Economic decisions stop being political. They become technical. Budgets are written for creditors. Policies are reviewed by external institutions. Elections change leaders but not direction. Dependence doesn't feel like occupation. It feels like responsibility. And that's the genius of the system. No force is required. No threats are made. Compliance is voluntary because alternatives are worse. The breaking point, when loans can no longer hide the cost. Every debt-dependent economy eventually hits a wall. Debt servicing consumes education budgets, healthcare funding, infrastructure investment. citizens feel the pressure. Higher taxes, fewer services, lower wages, fewer opportunities, social unrest grows. Trust erodes. Political instability rises. At this moment, the system offers only one solution: more loans, not to grow, not to invest, but to prevent collapse. It's the fallout who really pays. When dependence deepens, the cost is distributed unevenly. Those who lose the most: wage earners, small businesses, pensioners, public sector workers; those who remain insulated: international creditors, large asset holders. Multinational corporations, local wealth shrinks, foreign ownership expands. What looks like stabilization is often quiet extraction, the illusion of choice. At this stage, nations are told they still have choices, but they're limited to restructuring austerity, asset sales policy concessions, true independence, debt forgiveness. Radical reform, monetary autonomy is framed as reckless or impossible. The system defines what is responsible, and responsibility always means repayment. Failed fixes: why restructuring never ends dependence. Debt restructuring sounds like relief. Extended maturities, lower interest rates, temporary breathing room. But restructuring rarely reduces total burden. It delays repayment, preserves creditor control, resets dependency. The core issue remains untouched. Debt continues to exceed productive capacity. The cycle resumes slower, perhaps, but intact. Modern parallels: the pattern is everywhere. Modern parallels: the pattern is everywhere. This isn't limited to developing nations. Look at the modern global economy. Households rely on credit cards, student loans, mortgages. Corporations depend on cheap debt refinancing, financial engineering. Governments run permanent deficits, expanding balance sheets, endless rollovers. Dependence has gone mainstream. Entire economies are structured around never paying off what is owed. The shocking data point without numbers: consider this reality. More nations today spend more servicing debt than investing in their future. Debt payments outrank education, healthcare, infrastructure. This isn't mismanagement. It's design. Because once debt dominates budgets, priorities no longer belong to the people. They belong to the calendar. Why the system persists? So why doesn't this system collapse under its own weight? Because it benefits stability at the top. Creditors receive predictable returns. Institutions maintain influence. Markets avoid sudden shocks. Permanent dependence is safer than uncertainty. From the system's perspective, endless loans are a feature, not a failure. The long game: control through time. This is the heart of the long game. Loans don't conquer territory. They conquer time. They shape future budgets, future policies, future generations. A nation in debt isn't controlled today. It's controlled tomorrow. And tomorrow is where real power lives. It's a repeating cycle. Every debt-dependent system follows the same arc. Crisis rescue loans. Conditional reforms: slower growth, rising debt burden, renewed crisis. Repeat, with fewer options each time. Dependence deepens, exit narrows. Why escape is sulfur monoxide rare. Escaping permanent dependence requires short-term pain, political courage, loss, acceptance, structural reform. Most systems aren't built to survive that transition, so they choose stability over freedom, again and again. 3 clear takeaways. 1. Endless loans are not neutral tools. They shape policy, priorities, and sovereignty. 2. Dependence grows quietly, not dramatically. By the time it's visible, options are limited. 3. The system rewards continuity, not independence. Those who repay fully exit influence, and influence is valuable. Final warning and open question: every generation believes debt is temporary. History shows otherwise. The question isn't whether endless loans create dependence. The question is whether a system built on permanent borrowing can ever allow true independence, or whether dependence is the point. Call to action: if this video changed how you see loans, debt, and development, share it. Subscribe for deep, serious explorations of money, power, and economic systems. And comment below: at what point does help quietly become control? Because once you understand the long game, endless loans look very different.